Right, so looking at our information, I took this question from the Gauteng prelim exam. It was, I think, 2015. We are given an extract of the pre-adjustment trial balance. Let's just quickly get a pen out. Okay, so we've got a pre-adjustment trial balance on the 30th of June 2015. So that is obviously the end of our financial year. Right, so as normal or as usual, I've got a balance sheet account section and then a nominal account section. Now, as I already mentioned, I'm focusing on the income statement or the statement of comprehensive income. So before we tackle the year-end adjustments, let's quickly bring down balances in terms of the income statement. Right, so as you can see, I've already brought down sales and debtors allowance. Remember, sales minus debtors allowance. Cost of sales was filled in for me. So let's move on to the other balances. So sales, cost of sales, debtors allowance filled in. Then we've got fee income, 145,235. So I just want to quickly bring that down in brackets. I like to do it right at the beginning before I tackle the year-end adjustments. Remember, every amount you bring down is obviously worth a mark. So in brackets, 145,235. Right, the next amount, rent income. So if we go to rent income, our rent income 172,500. So let's just bring that down as well in our income statement. So in brackets, an amount of 172,500. Right, profit and sale of asset, we'll obviously come to that later on. Let's now look at our operating expenses. Okay. So we've got interest income. We can bring that down before we tackle operating expenses. So interest income, 3,500, and obviously that appears at the bottom of my income statement. So at the bottom, okay, so I should have interest income, okay, and in brackets, my interest income, an amount of 3,500. Right, next item, salary and wages. So an operating expense, let's bring this down, 288,090. Okay, so salary and wages in brackets, bringing down for the year before adjustments, 288,090. Okay, my next expense after salary and wages is audit fees. Let's just bring that down so you guys can see. So I've got audit fees, 52,000. So I'm going to quickly bring that down in brackets, 52,000, followed by my next expense after audit fees. Okay, just go down a bit quickly. Okay, just going to move that. So my next expense, director's fees, an amount of 375,000. Okay, so director's fees in brackets 375,000. Right, next expense should be consumable stores. Okay, so consumable stores, an amount of 104,100. Okay, just go back a bit. Consumable stores. Okay, in brackets 104,100. Depreciation, there wasn't anything given to me. And then bank charges, an amount of, okay, just quickly check, bank charges, an amount of 6,740. So just want to quickly bring that down and then we can start tackling our year-end adjustments, 6,740. Right, now I want to quickly go back to the pre-adjustment trial balance, and you would have noticed ordinary share dividends or dividends on ordinary shares, 45,000. I am not bringing down this amount in my income statement. Now remember guys, part of this question, which we're probably not going to get to because the income statement takes quite a while, was to draw up retained income. the note for retained income. So remember, ordinary share dividends, if it appears in the trial balance, this is obviously your interim dividend that was paid during the financial year. So I want you guys to please remember this. Often we see students putting this amount in the income statement, and remember that is incorrect. That is regarded as a foreign item, and often you will lose a mark, a negative mark, for placing this amount in the income statement. So your ordinary share dividend, if it appears in the trial balance, this is your interim dividend that was paid during the year, and it needs to be recorded in the retained income note. I want you guys to please remember that. Right, now that we've brought down our balances, let's now tackle our adjustments. So let's now go to the adjustments. Okay, so the very first adjustment, adjustment A, the auditors are owed a further 23,000 after completing the audit. So obviously for the current financial year. Now remember, our financial year ends on the 30th of June. So obviously at the end of the financial year, there must have been an audit by external auditors, and the business is still owing an amount of 23,000. So because it's part of the financial year, I am now going to include this expense in my income statement. So let's go to the income statement, and audit fees, let's now include an amount of 23,000. So I just want to quickly find the income statement, and there we go, audit fees. Remember, we are now including the 23,000. Okay, simple, straightforward. Right, let's now move on. So the second part to the adjustment, obviously one account affected was audit fees, which we dealt with already in the income statement or statement of comprehensive income. It's going to take us a while to get used to that because we're so used to calling it the income statement. Right, the other account affected, guys, still owing, obviously, accrued expense. Now remember, in this particular question, as I said, we're focusing on the income statement, but accrued expense would have been recorded in trade and other payables. So in the balance sheet or the balance sheet note, trade and other payables, that is where you would also record the 23,000 as accrued expense. But I know you guys probably knew this already. Okay, remember, it's all about revision. It's all about reminding you guys where to record the amounts. Right, let's now move on to adjustment B. A credit note for 900 Rand dated the 28th of June 2015 was issued to a debtor, C Plain, for unsatisfactory sewing on a suit jacket. This transaction was not recorded. Right, now when it comes to this particular transaction, guys, be very careful. They are not telling you that the debtor, C Plain, the name of the debtor, that he returned the suit. All they're telling you is that he wasn't happy with the sewing on the suit jacket. So he probably sent his jacket in for altering or taking it in or whatever the case may be. And he wasn't happy with the alteration of the suit. So he is now, or he has been granted a credit note of 900 Rand, a reduction of 900 Rand. So the two accounts that will be affected with this 900 Rand will be fee income, okay, because remember, the business obviously rendered a service, and the other account affected is debtors control. Okay, so fee income and debtors control. Right, let's start off with fee income. So if you look at fee income, obviously by giving him a reduction of 900 Rand, your fee income is now going to decrease by 900 Rand. So in our income statement, let's quickly go to the income statement and let's go to fee income. We are going to minus 900. Okay, everyone happy with that? Right, then debtors control, Okay, let's quickly go back. So debtors control, remember the debtor obviously is getting a reduction of 900 Rand, which means your debtor owes you less. So debtors control will decrease by 900 Rand. Now remember guys, obviously again, and I know I've said this when I was doing adjustment A, we're focusing on the income statement. So fee income affected the income statement. Debtors control obviously affects trade and other receivable or your balance sheet if you're doing everything directly in the balance sheet itself. So debtors control minus 900 Rand. And what I'm going to do, just in case we do come across provision for bad debts adjustment, I want to quickly go to my trial balance. Okay, so debtors control in brackets, I just want to make a note that it decreases by 900 Rand, just in case I need to use this information later on when calculating the provision for bad debts adjustment. Okay, right, second adjustment done and dusted. Let's now move on to adjustment number C. I just want to quickly erase this so that I've got a bit of space here and I don't need to move down and not be able to read the adjustment. So just bear with me guys, let me just quickly erase. Okay, there we go, and I've got space now. Right, so let's look at adjustment C. The physical stock count on the 30th of June 2015 revealed the following on hand. Trading stock 315,000, consumable stores 4,000 Rand. Right, so let's start off with trading stock. So let's go to our trial balance and let's look at what is the book value of our trading stock. Now remember guys, when I say book value, according to our general ledger, how much of trading stock do we have at the end of the financial year? So let's do that. Let's go to the trial balance. So if we go to trading stock, this is our book value. The amount of trading stock we have, 325,000. So I just want to take that through. 325,000 according to our books, according to our general ledger. But when we do a physical count, so when we count each item in the business, this amount of trading stock we have is 315,000. So clearly there is stock missing. There is a deficit. Okay, stock missing of, it should be 10,000. So let's just quickly check. 325 minus 315 should be 10,000 Rand worth of stock is missing. Right, two accounts affected, obviously trading stock as well as trading stock deficit. So let's go to the income statement and let's record our trading stock deficit under operating expenses. Okay, so we've got trading stock deficit. Okay, so trading stock deficit, always nice to show your calculations in brackets. So I took 325,000 minus the 300 and I think it was 15,000, and that gave me a trading stock deficit of 10,000. Okay. Right, please remember guys, again, because this is a revision lesson, if you come across any adjustments in terms of trading stock before the physical stock count, please remember you've got to adjust your book value according to the adjustment. But in this case, we didn't have any adjustments, so we went straight to comparing book value to physical stock count. Right, still with adjustment C, so the next part to the adjustment is your consumable stores. Right, now please guys, consumable stores is simply another word for packing material. So please don't confuse this with consumables on hand. So consumable stores, an expense. Right, so if we look at consumable stores, when we physically counted our consumable stores, there's obviously 4,000 Rand worth of consumables on hand. So remember, obviously, if we look at your ledger account, consumable stores, I just want to quickly go to the trial balance. And at the moment, your consumable stores is sitting at 104,100. Let me just quickly bring that down. Okay, so at the moment, the expense is 104,100. And obviously, you didn't end up using all the consumable stores. Remember, I said it could be packing material, it could be cleaning materials that are called consumable stores. So in your storeroom, there's still 4,000 Rand worth of these cleaning materials unused at the end of the year. So obviously your expense decreases by 4,000 Rand because that 4,000 Rand becomes an asset called consumable stores on hand, or I like to just call it consumables on hand. Right, so consumables on hand, obviously you will show this in your inventory note in the balance sheet. But let's go to the income statement now and let's minus the 4,000 Rand from consumable stores, the expense. Okay, so let's do that quickly. So going to our income statement, consumable stores, right, remember we are subtracting an amount of 4,000 Rand. Okay. Right, let's do one more adjustment and then we'll take a quick break. And you guys can, just stretch your legs a bit if you need to. Let's just quickly find the adjustment. Right, there we go. So adjustment C completed. The next adjustment D, this one, guys, is an important one. It will appear in every exam. And remember, the adjustment could be worded differently. So please make sure that you are comfortable with this adjustment in any way in which they could test the adjustment. Right, a retired employee was included or mistakenly included in the salaries journal for June 2015. So you've got someone that is no longer working for the business, but by mistake, this person was included in the June's salary journal. The details from his payslip were net salary 18,375. Then we've got PAYE deduction, so his tax 4,500, pension deduction 1,875, UIF deduction 250, and then they tell you the business contributions were to the pension fund 10.5% of the gross salary, and UIF is a Rand for Rand basis. Okay. Right, now when it comes to this particular adjustment, please remember, guys, that your gross salary is always your expense. And as you can see, in this particular case, your gross salary is not given. All the deductions that I've just read out, your PAYE, pension deduction, UIF deductions, all are liabilities. In other words, they would be recorded in trade and other payables. Net salary is also a liability. In other words, the amount that you will be paying to the actual worker. Now, looking at this particular adjustment, as you can see, your gross salary is missing, is not given to you. But remember, your gross salary is simply the sum of net salary plus your tax PAYE deduction, plus your pension deduction, plus the UIF deduction. So let's work out what is the net salary. Let's just clear that out. Okay, so my net salary, remember I'm adding, so my gross salary, I'm adding net salary 18,375 plus 4,500. Okay, plus 1,875 plus 250, and that is giving us an amount of 25,000. So that is your gross salary. Right, now when it comes to the actual adjustment itself, if we go back to the very beginning, remember in error we included someone that retired in the salaries journal. That person should not be in the salaries journal because that person no longer works for the business. So I need to now I need to subtract this amount from my income statement, salary and wages amount that is given to me. Okay, so there's your gross salary, 25,000. And remember what I said earlier on, that is your expense. So we're now going to go to our income statement and we are going to minus the 25,000 from salary and wages, because that expense obviously does not or should not be included in our income statement. Okay, so remember, there we go, salary and wages. By mistake, we included the amount in the 288,090. So we now need to exclude minus the 25,000. Please guys, remember it's 25,000, the gross salary. Okay, right, if we read on, we're not done with the adjustment. So if we go back to the adjustment, okay, there we go. So we've recorded the 25,000. We are then told the business contributions were pension fund 10.5% of gross salary, UIF rand for rand basis. All contributions are debited to the salary and wages account. So in other words, in addition to his salary, he also receives additional pension from the business's contribution, as well as a contribution for UIF. So once again, remember, by mistake, these amounts were included. We will now have to calculate the amount and exclude this amount from salary and wages in the income statement. So let's calculate the amounts. Let's start with the pension fund. It's 10.5% of gross salary. So 25,000 times, okay, 10.5%. Okay, let's just divide that by 100. Okay, and that's giving us an amount of 2,625. Okay, 2,625, and then UIF is rand for rand basis. So 250 is the workers' contribution. The business also contributes 250. So remember, as I said, we're going to now subtract these amounts. We've got to exclude these amounts from the salary and wages account. So let's do that. Let's go to the income statement. Okay, let's quickly find that. So in our income statement, salary and wages minus 2,600 and I think it was 25, it was. Okay, and remember guys, we're also subtracting that amount of 250. Okay, before I continue with the next adjustment, I just want to quickly go back to the salary and wages adjustment. Right, now obviously we're doing an income statement. We made the necessary adjustments already in the income statement. But remember, if you were also doing the balance sheet note, trade and other payables, and I'm doing this guys because it's important. So if you were also doing trade and other payables, right, please remember that all your liabilities, so creditors for salary is your net salary. So you would have brought down creditors for salary. Please remember, you would then minus the amount of 18,375 from your trade and other payable note. Similarly, your PAYE deduction, which is also under trade and other payables, so PAYE, again, you would subtract 4,500 from the total that you brought down. Do the same for pension deduction, minus 1,875, and UIF, once again, you are subtracting. And remember, even your additional contributions, you would also subtract from trade and other payables. So please remember that. Read the adjustment very, very carefully, because in this case, we had to subtract subtract. But if, for example, someone was left out from the salary journal, remember, then you would have to include them. So make sure you read very carefully. Right, let's now move on to adjustment E, which tests your knowledge on interest being capitalized. So remember, capitalization of interest could be tested in your financial statements, income statement, balance sheet, or in the cash flow statement. So either way, guys, it's there in your exam. Please make sure you understand this particular concept. So let's read. The loan statement from Kelly Bank on the 30th of June 2015 reflects the following. So you've got loan statement, right? Balance on the 1st of July 2014. Obviously, this is at the beginning of the year, 665,600. So that's my balance at the beginning of the year. Total payments during the year, 103,200. Then I've got balance on the 30th of June 2015. So obviously end of the financial year, my loan is sitting at 652,000. And then I've got additional information. The interest for the year must be capitalized. A capital amount of 50,000 will be paid towards the loan in the next financial year. So as you can see, I'm going to use my general ledger loan account for this calculation. So remember, your loan, obviously a liability, right? Decreases on the debit side, increases on the credit side. So at the beginning of the year, my loan is sitting at 665,600, okay, brought down beginning of the year. At the end of the year, my loan is now sitting at 652,000. Okay, interest is capitalized, means interest is obviously added to your loan. Right, so the interest is the amount that is not given to me, and I'm going to put a question mark. That's what I need to calculate. What was the interest added to my loan for this financial year? Now we've also got repayments during the year, and remember, repayments obviously decreases your liability, it decreases the actual loan itself. So the total repayments for the year, an amount of 103,200. Okay, now remember guys, the reason why I'm drawing up a T account is because this is going to make sure, or this is going to assist me to calculate my interest for the year. So as accounting students, we know that when we bring down a balance brought down and we have a balance carried down, the debit side is equal to the credit side. So if I want to calculate my interest, all I'm doing is I am taking 103,200 plus 652,000, okay, and then I am going to simply subtract 665,600, okay. So I'm adding and then I am subtracting. Okay, so let's do that quickly on our calculator. Let's just move that so you guys can see. You guys just make sure you are working this out with me, please, guys. Okay, so we've got 103,200, right? And then we are adding 652,000 minus 665,600. Okay, and that gives us the interest for the year, the amount that wasn't given to me. I had to calculate 89,600. Okay, so that is my interest expense for this financial year. Okay, so guys, please remember, I know you can easily do this as a sum, absolutely fine, where I'm adding, where I'm subtracting, but often what we find when we're marking is sometimes you don't know when to add and when to subtract. But when you're doing the actual T account, then it's like, hang on, I can do this. I'm adding and then I am subtracting. Okay, so let's take that through to our income statement, 89,600. Okay, and that's my interest expense. So it's an amount of 89,600. Remember, it's got to be in brackets. You may come across other interest expenses, for example, interest on overdraft. If that was the case, remember, you are showing your calculations in brackets. Right, so please make sure that for this amount, the calculation that I did earlier on, that you've got the calculation in brackets. Don't ever show calculations on your question paper where the information is. Let me just say that again. Don't show calculations on your information book. Show your calculations on your answer booklet, okay? And remember, if you show calculations in brackets, then obviously that is first prize. But in the event of you feeling, I don't have enough space, then somewhere on your answer book, just reference this, and I promise you, whoever's marking will look for that reference and give you part marks if it is necessary, okay? Right, interest expense sorted. The next part to this adjustment, even though it doesn't affect the income statement, I do want to talk about it. So let's look at the second part. A capital amount of 50,000 will be paid towards the loan in the next financial year. Now remember guys, here they are referring to your non-current liability. Can you distinguish between a non-current liability and a current liability? So remember, this obviously affects your balance sheet. And if you are not given the balance sheet, then you obviously need to show this in trade and other payable note. Right, so even though we are not given the balance sheet, because this is so important, I'm going to quickly explain this adjustment. So let's assume we were asked to do the balance sheet. So we've got non-current liabilities, right? And obviously we've got this loan, right, from Kelly Bank. And at the end of the year, my loan is sitting at 652,000. Now remember guys, non-current liability, an amount owing for more than a year, for more than 12 months. Current liability, on the other hand, is a liability that is owed or will be paid off in less than 12 months. Current liability, less than 12 months. Non-current liability, more than 12 months. So if you look at this adjustment, they are telling you that 50,000 will be paid in the next financial year. In other words, within the next 12 months, the business is going to repay 50,000. So what we need to do is, in our balance sheet, that 50,000 is no longer a non-current liability. So we're going to subtract 50,000 from non-current liability, and we're going to simply show that 50,000 under current liability. So remember, you can show this under trade and other payable, or you can show this separately as short-term loan. Okay, so remember, that is where you're going to then disclose this 50,000. So in other words, your shareholders can clearly see that 50,000 will be paid within 12 months. It's a current liability. Okay, so please guys remember this, because it's an adjustment that is often tested. Right, let's move on to another adjustment that also is tested all the time in your exams, and you guys seem to always battle with this adjustment. I just want to make a bit of space here for the calculation for the next adjustment. So you guys just bear with me, please. Okay, there we go. Enough of writing space. Right, so the adjustment I'm now referring to is your rent adjustment. The tenant owes, okay, not going to help without a pen. The tenant owes the rent for June 2015, right? So the tenant still owes the rent for June 2015. So clearly I'm dealing with an accrued income. The rent was increased by 1,500 Rand per month on the 1st of January 2015. Now, when it comes to this particular adjustment, I always like to have my timeline drawn up. Okay, and I know you guys also prefer to draw up the timeline. It just helps you to calculate or rather count the number of months. Right, so I've got 1st of July 2014, beginning of the financial year, 30th of June 2015, end of the financial year. Now, in terms of this adjustment, the tenant has not paid the rent for June. Okay, which means the tenant has only paid for 11 months. Remember, financial year, 12 months, hasn't paid for the month of June. Right, now the monthly rent is clearly not given to us, but we do know in total, let's go to our trial balance, in total, the rent that we have received is 172,500. So I just want to take that through, okay? So the rent that we have received for the 11 months, an amount of 172,500. Okay. Right, now there's two ways in which we can do this calculation, and I'm going to show you guys both methods. You decide which one you want to use. We know the rent increased on the 1st of Jan. So the rent increased on the 1st of Jan by an amount of 1,500. Okay, now what does this mean? It means for the month of January, February, March, April, and the month of May. Remember, June wasn't paid. So each month for 1, 2, 3, 4, 5. For 5 months, we've received an additional 1,500. So if we take 5 times 1,500, right, the additional amount that we have been receiving each month, so 5 times 1,500 is an amount of 7,500. Okay, all we've got to do is take our total rent received, 172,500 minus 7,500, right? And that will give us obviously the rent before the increase, and we're going to divide this by 11. So that should give us our old rent before the increase, because as you can see, I've clearly subtracted the increase. So let's do that. Okay, so we've got the total rent 172,500 minus 7,500. Okay, and if we divide that by 11, okay, that gives us the old rent, which is 15,000. Just want to quickly check that one more time, guys. Yeah, it's 15,000. So remember, the rent for June is what we are trying to calculate. What is the rent for the month of June? So it's the old rent, 15,000, plus the additional 1,500. So clearly the tenant is owing us a total of 16,500. Okay, everyone happy with that? Right, now this method that I've just shown you is the easier method, or most of my students think so, right? But remember guys, nothing stops you from letting the rent equal to X and simply solving for X. Okay, so even if you do that, absolutely fine. So when I say let the rent equal to X, remember, for the first 6 months, okay, from the 1st of July until the 1st of Jan, we can quickly make sure it is 6 months. So July, August, September, October, November, December. So 1, 2, 3, 4, 5, 6. So for 6 months, your rent is obviously X plus, and then for the next 5 months, right, your rent is X plus 1,500, and that is obviously equal to the total, which is 172,500. Remember, what we're doing now is we're just solving for X and making sure that we get that same answer, because many of you like to solve for X. X is the monthly rent. Right, so 6X plus 5 times X is obviously 5X plus 5 times 1,500 is 7,500 is equal to 172,500, and now it's easy. 6x plus 5x is 11x is equal to 172,500. Obviously, if I take this to the other side, minus 7,500. Okay, so 11x is equal to, just get the calculator out, right? So 172,500. Okay, and as you can see, we're basically doing the same thing, just trying to move this, guys. So minus 7,500, right? And that gives us 165,000. I want to know what x is. I'm going to divide by 11, and x is equal to, okay, so divide that by 11. And as you can see, we're getting the same amount, 15,000. Okay, so remember that's the old rent, and obviously that was the amount that we got above there, plus 1,500 gives us the adjustment amount of 16,500. Okay, so as I said, guys, you decide which method you want to use, right? Both methods going to give you the same amount. Now that I have the adjustment, 16,500, please remember that the two accounts that will get affected with the 16,500, obviously my rent income. Okay, so I've got rent income, and the other account affected is accrued income. Okay, so rent income, this amount is still owed. So obviously rent income, I am now going to include the 16,500 in my income statement. So let's do that. Let's go to the income statement, and rent income, we are now adding 16,500. And the other account affected is, let's just quickly go down. Right, accrued income, and accrued income will affect trade and other receivables. So remember, accrued income, you will obviously show the 16,500 in trade and other receivables, right, the balance sheet note, and you will fill in accrued income, and that is where you're going to show the 16,500. Okay, right. Adjustment done. Which adjustment was it? Adjustment F. Let's now move on to the next adjustment. I'm just going to quickly go back. Okay, so adjustment G, guys, I don't know whether we're going to be able to finish this adjustment. I'm going to try because it's quite a complicated adjustment. We needed to calculate the cost price, accumulated depreciation. Let's see how time goes. We probably won't get to the asset disposal ledger account, which I actually wanted to do with you guys, but let's maybe focus on the calculation for depreciation. We've got just under 6 minutes left, so that should be enough of time for us to tackle the depreciation calculation. Right, so adjustment G is on tangible assets. So I'm given balances on the 1st of July 2014. So obviously at the beginning of the financial year. So I've got land and buildings 11 million, vehicles 900,000, accumulated depreciation on vehicles 390,000. Now remember, I was also given a trial balance with balances at the end of the year. Okay, right, then I'm told the following. A vehicle bought on the 1st of July 2013 was sold for cash on the 31st of December 2014 at a profit of 5,000 Rand. A new vehicle for 200,000 Rand was bought on the 30th of June 2015, and then depreciation on vehicles is written off at 20% per annum on the diminishing balance method. Right, now in this particular question, and I didn't include it, because of time constraints, we had to complete the tangible asset note. Right, now looking at the tangible asset note itself, let's quickly try and draw up a tangible asset note. I know that we're going to run out of time, but guys, we'll focus on what we can do. So obviously we've got land and buildings, okay, and then we've also got vehicles, right? So let's quickly tackle land and buildings first, and then we'll get to vehicles. So my land and buildings cost at the beginning of the year, okay, so if we scroll to the top of the page, land and buildings at the beginning of the year is 11 million. Okay. So obviously for land and buildings, there is no accumulated depreciation. You guys obviously know that, right? And my carrying value at the beginning of the year, so carrying value at the beginning of the year for land and buildings is also 11 million. Right, then movements is what happened during the year. So remember, under movements, additions at cost, we could have had a disposal at carrying value, and obviously depreciation. Right, now looking at the information given, there's obviously no disposals for land and buildings, nor is there any depreciation. Now, is there an addition? Now, remember, we are given our trial balance. So if we go to land and buildings, guys, I'm going to have to correct myself because I made a mistake with what I said earlier on. So if we look at land and buildings at the end of the financial year, it is sitting at 10,200,000. Okay, so let's just go to the note that I drew up. Okay, so at the end of the year, my land and buildings is sitting at 10,200,000. So we can clearly see that there hasn't been an addition, because if there was an addition, obviously this value would have increased. But as you can see, the value decreased, which means that there was property that we disposed of. So remember, I said earlier on that there wasn't any, that was my mistake. So there is a disposal for land and buildings, because if we compare carrying value at the beginning of the year to my carrying value at the end of the year, I can clearly see there is a difference. Okay, so let's look at the value of the property that we've disposed of. So 11 million minus 10,200,000. Okay, lots of zeros. I just want to make sure that I haven't missed out anything. So the property that we've disposed of, disposal of at carrying value 800,000. Okay, and that needs to be in brackets. So there wasn't an addition, so that was the error that I made. I thought there was an addition, but clearly there isn't. Okay, so let's just complete the rest of this note. So this is my carrying value at the end of the year. Okay, the amount given to me, right? And obviously my cost at the end of the year is also 10,200,000, and there's no accumulated depreciation. Okay,